Okay, so now the next thing we're going to look at is you have to diversify. Now, some people think if they buy 4 different S&P 500 funds, or even um, like a S&P fund and a tech fund, and they're actually diversifying. But often you'll find that the same shares are repeated. For example, Nvidia is in the S&P 500, it's in the Nasdaq, it'll be in the tech fund. So some people think they're diversifying by doing that, but that's not true diversification. Diversification is also over asset classes as well. So in other words, if you've got dividend shares, that's great. My view, and I don't know if others believe in it, but my view, and it's not financial advice, don't take it as financial advice, but anything in this video, don't take it as financial advice. It's just financial information and entertainment. But if you diversify, if you have, for example, I believe in having growth shares as well as dividend shares. So your dividends is paying your income, and then you have growth shares. Now, most growth shares don't pay a dividend, or if they do, they pay a very small dividend. But what they do is they reinvest. The profits they make, they reinvest into the company, and they grow. There's some companies making having a very high growth rate over a longer period of time. So you want something that will look into the future. I will actually talk about one of these companies that I've seen. I will do a video on it separately. That I believe is going to be the future. It's going to be the best. I can see it already. So you look into the future, and then nobody knows the future, but your growth shares should go up over time. Obviously, you can use ETFs. You can go into individual shares. You've got robotic and AI. You've got semiconductor. You've got different ETFs that you can look at. You've got also index like S&P 500. You've got Nasdaq. You've got Dow. So you diversify like that, but also diversification. The way I look at it, they always spoke about bonds, like a 60-40 bond was the ideal portfolio, or they use your age. In other words, 100 minus your age, or 120 now minus your age should be the amount of stocks you have in your portfolio. I don't believe in that. I believe in your risk profile. It dictates more what you should have. And also I believe in having some fixed income, but also, and you can increase that over time, but also having your growth shares. And when you come to retirement, then obviously you can obviously sell off some of your growth shares to fund your retirement. Or you can live off your dividends of your shares. Okay, and then also with what I look at now, what I've heard of the new one is 60-20-20, which is 60 stocks, 20 bonds, and then 20 gold, or like 15 gold and 5 crypto, like Bitcoin or something like that. Now, the jury's still out on Bitcoin. It has been massively adopted, but it's really dropped when everyone was expecting it to go up. So I was watching from the sidelines, and I was very surprised to see it go down to went down to about 60, low 60s. But anyway, some people say you should have that. Like I say, it's not financial advice. It's not. I don't have any Bitcoin or crypto at the moment, but I do have gold and silver, and I believe that having some gold and silver, like I say, diversify, 60-20-20, So having, say, 20% in gold and silver, or whatever percent you feel comfortable with, because gold and silver will go up over time with the American dollar is on a downward spiral. It keeps devaluing, and it's because of excessive government debt and money printing. Every time they turn around, they've printed more money, and they use it. Obviously, it's overspending for whatever reasons, but they're issuing new bonds all the time, and the problem is money printing causes inflation, which is a problem. And also, like I said, devalues the currency. So but it also pushes the price of gold up. So over time, we will see. We probably should see, like I should say, a higher gold price, and then silver and other precious metals, even copper, over time, because there is a huge difference in the supply and demand. You can't just get a copper mine up and running or a silver mine. And the thing is, some of them are byproducts of the other one. So, you have to, it's not just this thing that you can just turn on a tap and turn off. So you've got huge, this over a 10-year period, copper will do quite well. Silver also. Silver's got a lot of uses. It was actually used many years ago as currency, silver. People also use gold as currency, and also but it's also got many uses, like, for example, EVs, solar panels. It's a great electrical conductor. And some of these also go for copper as well. So obviously, for all these data centers that are being built out, they need a huge amount of this. There's a large portion of the world that's actually needs electrification. It's underdeveloped. So as they roll out this, the demand for copper is huge. So over a 10-year period or so, copper should do well. But silver also. Silver, with what I mentioned, there's another few things as well that silver's used for. It's got many uses, plus it's a store of value as well. And it was declared a critical mineral about a month ago or so. They declared it on the critical list. So yeah, so they say that you should hold some of that in your portfolio, not half or the whole portfolio, but have a little bit and just add to it monthly if you can. Just to increase your diversification. It's just a different asset class. Obviously, you've got gold mining shares and mining shares, which is also doing quite well. Goldfields came out with the results the other day, and they more than doubled their dividend and gave a special dividend as well. They announced that. So that gold price is now starting to filter through, and that was on a lower gold price than it was now. The fourth quarter was like 3,500 or something, or 4,000, and now we're sitting about 5,000. And it has come off. It was 5.5, so it's actually come off, and that was actually, in hindsight, a pretty good buying opportunity. But yeah, okay. So what else can we talk about? Okay, so retirement. So retirement, a lot of people look at retirement, say they get to 65 or whatever. Obviously, if they've not saved enough, they might have to work past 65. Some people retire very early. They retire at 60 or 55, or some people even retire in their 30s or whatever. So everyone's different. But retirement is not the finishing line. Retirement is actually the starting line almost. So it's the end of one working, receiving your salary, and it's the beginning of of actually living without a salary. So you have to generate your own income for retirement. So if you start early enough, which is the best thing to do, you can put money away, and then when you get to 65, you load it. They actually say if you put money into a tax-free savings account for a newborn, when they're newborn, if you put 36,000 in, which is the maximum at this stage, and you don't put any more money in, you just invest that in just an index fund. If you'd invested in the although it wasn't available when, back then, but if you did, hypothetically, then you would have like millions. So, but start as early as you can. Obviously, if you get behind or whatever, I only found out about tax-free savings accounts like about just over a year ago. But better late than never. So the plan is to try and max out every year. That's 36,000 Rand a year, which works out about 3,000 Rand a month. Obviously, if you get a tax refund, then obviously that can help you to pay in. Because basically you've got different things. You've got your tax-free savings account in South Africa. We've got tax-free. I think it's similar to a Roth IRA that they call in America, but we can actually pay in 36 next year. Next year feels like next year. Next month. Next week. So next week. Okay, now my age is showing. Next week is the 25th. Next Wednesday, I think it is the budget. And people are putting forward that they should try and increase the limits. The tax-free savings accounts start in 2015, and they've increased the limits, I think, once or twice. And like I said, I only found out about it about a year and a half ago. But so they've increased the limit twice, but now they're talking about maybe hopefully they can increase the limit again to 40,000. I don't know if they're going to increase the lifetime limit. The lifetime limit is 500,000. They were hoping for 600,000, but I don't know. We'll see what they do. Well, we can only guess until they come out on Wednesday and tell us where they're taking our money. So, because obviously, you get higher taxes on something, so they give with one hand and take with the other, and then hopefully they can lift the tax rate slightly to count for fiscal drag. Fiscal drag is something that, if you get a small increase at work, then it takes you up into sometimes a higher tax bracket. But obviously, we got like a ladder system on our tax, so the more you earn, the more tax you pay, basically. So hopefully they can account for inflation with this. Let's hope they do that. So otherwise, we're getting poorer. We're getting poorer with an increase. So yeah, let's hope the government can do that. But yeah, so okay. Let me also now talk about you got your tax-free savings account, which obviously grows tax-free. You can have like a brokerage account, which obviously both of them accounts you can earn dividends from both of those accounts. Okay, so in other words, when you get to retirement, you can use both of them accounts dividends to live off, or partly live off if you can. Okay, so but then you've also got hopefully if you got like an RA, retirement annuity, then you can take 1/3 in cash and then take the 2/3 as a monthly annuity. So in other words, you get that monthly amount from them, but that's usually like a fixed amount. You can increase it with inflation if you want, but then obviously they give you a lower starting amount. And then your tax-free savings account, your brokerage, obviously you can, if your dividends and your money from your RA or any pensions that you have. And also South Africa has actually brought in a new thing recently now this week, where they say you're going to be auto enrolled into a pension, which is probably a good thing because there's a lot of companies who don't offer a pension. So we'll see how that works. So it looks like automatically you're going to belong to a pension fund. So in other words, they're going to have to deduct it. You can't, by default, you're in a pension. Otherwise, unless you say, no, I don't want to be in it. So, yeah, maybe that's a good thing. The government wants us to save money for retirement, so we're not as a burden on them. We don't get Social Security, but there is a SASSA, but obviously you have to qualify for that. If you have assets over a certain amount, then obviously you don't qualify. But yeah, we'll see. It's a small amount, but added to everything, it might help. But but that's why I'm trying to increase my income factory to get as much dividends as I can every month, and obviously build up the retirement annuity. So then that will hopefully cover or close to cover most of the income that I need. Otherwise you have to just supplement that with other forms of like part-time work or something. So the best thing to do with your portfolio, and I must admit I'm probably the worst one to say this, is is do nothing. I do often tinker with the brokerage account, sometimes buying and selling, and sometimes it works well. But to be honest, what you can actually compare it to, it's like if you got a bar of soap. The more you use the soap, the smaller it gets. So that's a lesson I'm trying to learn. I'm going to try and learn from 1st of March, from the new tax year. I'm actually going to try to stop tinkering with it. You can't just leave the account to run. Maybe add to some shares if I want to, or just reinvest the dividends, and obviously focus on the tax-free savings account to try and max that out, because your tax-free savings account is after-tax money you pay in, but it grows tax-free, and then when you take it out, it's tax-free. So when you pull in retirement, people talk about the 4% rule, which was the norm in America. Now apparently they've increased it to a 4.8% rule. They say if you have enough money, if you withdraw 4% of your salary, 4% of your portfolio, then it will cover your money. Your portfolio won't go down in value. You'll have enough money to run out. Some people actually have more than, obviously depends how the market does, because there is something what they call the sequence of return risk, which is if you retire just before a market crash, and the market crashes, let's say the market crashes 30%, and you withdraw say 5%, or even let's say you draw 10%. So you draw 10%, the market crashes 30%, so your portfolio is down 40%. In other words, if you started with $1 million, now you've only got 600,000, and you still got the rest of your life to live off that money. Okay, so with our annuity, we have like either a guaranteed annuity or a living annuity. The guaranteed annuity, the insurance company, it's like an insurance thing where they say you've got, for every so much you got with us, we'll give you X amount per month, like 1,000 or 2,000 or 3,000 per month. So we'll give you that per month for your annuity, and they give it to you until you pass away. And when you pass away, then that money stays with the insurance company. If you have a living annuity, then how your living annuity works is you can draw down, like the drawdown I was talking about, the 4% rule, 4.8% rule. You can draw anywhere from 2.5% to 17.5%. Obviously, if you draw 17.5%, you're going to run out of money quite quickly. And if you draw 2.5, you might not have enough income to live off. So you can also do like a blend. You can do half in one and half in the other. That's another option. But yeah, definitely, if you guys can build up a dividend income factory with your dividends paying out, the more you can earn, the better. But obviously, like I say, have a diversified portfolio as well. Have some growth shares in there. The growth shares over time should grow more than the dividend stocks. So your growth shares will increase. So you keep your growth shares, they increase over time, and then you draw your other money first. Like, for example, I would try and live off dividends and that, and then if I needed to go into something, I would then go into the brokerage and then start selling off the brokerage. But obviously then you're going to get less dividends sometimes. And then final is the tax-free. So let the tax-free grow as long as you can. That's the way I would. That's the way I think is the best way to do it. But like also with my growth tax-free savings account, I will have, and I have already, money in fixed income in there. That's also that I will grow over time. So in other words, I will have the cash available, because some people, what they do, let's say they only have a retirement annuity, they've only got the retirement annuity, say for example, and they say, okay, I want to withdraw like 4%, and that 4% doesn't cover their income. They don't have, if they only have a retirement annuity, they might have liquidity problems being able to pay their bills, because they're only getting that fixed amount from the insurance company, and you can only change it. Living annuity, you can change it once a year, but but the if you go with a living annuity, you can change the percentage once a year. So in other words, if you choose 2.5% and you haven't got enough money, you have to wait for a year to change it to a higher percentage. But if you have like a brokerage and you've got your tax-free paying income, you've got that cash. Because obviously what you do about a year or two before retirement, you I think it's called retired, because you do get tired. So what you do is you stop your payment, you stop your automatic reinvestments, maybe a year before retiring, or maybe 2 years, or whatever you feel comfortable with. You can always manually pay it in if you want to, but then you can actually gauge how much your tax-free savings account is paying you in monthly income through bonds, through dividends, through your different property, through this even like actively managed income funds and things like that. So you can actually then see, okay, you can actually see as they pay, as the money goes in, you can see and you can actually build that up as a cash buffer, and then keep it in cash to either buy whenever. If the market's down, you can buy with that, or you can keep it in cash to use as your cash buffer. And you can do the same obviously with a brokerage. You can stop your dividends and then keep your dividends for say 2 or 1, 2, or maybe even 3 years. Keep your dividends for 3 years. Don't take it. Don't reinvest it. Reinvest it when you're working. But before you stop working, stop your reinvestments, and then let that cash build up in your brokerage account, and then you can use that towards your cash that you might need when you retire. Yeah. So yeah, hopefully that was helpful. Like I said, it's not financial advice, but it's just the way I think and I look at things. And yeah, it's I think a lot of people retire with not enough, or can't retire because they don't have enough. Let me put it that way. But yeah, I think if you've got the right mindset and you start building, but start today, or start Monday, or whatever. It's Friday today, so start Monday. Start building for your retirement, and yeah, and just keep. And the other thing I was also going to say is most of your funds, some of your funds who have the best returns is actually the funds where the person has actually passed away, or the person has forgotten the password. Because like I said, with the soap, with the tinkering with the portfolio the whole time, buying and selling, you don't want to be doing that as well. And then holding is the best. Living off the dividends is also, from a tax point of view, is also the best, because you pay on South African shares, you pay a 20% withholding tax, but they take that tax off before they give it to you. So basically, the dividend you get from the company is actually tax free. With the tax-free savings account, they don't take any tax off there; they just pay it in like that. So that's even better. But yeah. So that's a very good thing for tax, because obviously you want to pay as little tax as you can, but also, like I say, it's, for me, the best thing to do is, if you need to withdraw from your portfolio, withdraw from brokerage first, and then obviously you take your other stuff first. If you've got your brokerage, and then leave your tax-free savings account till last. Let it accumulate as much as you can tax-free, and then yeah. So yeah, good luck on the journey. Look, it's everybody gets there, and sometimes, but don't put it off, because sometimes people say, retirement, I'll start next year. It's like losing weight, I'll start next year, and tomorrow never comes, so start as soon as you can. I mean, it's almost the end of February. If you start now, you can actually pay money into a tax-free savings account before the end of February for this year, and then you start again with a clean slate from March. So yeah, why not? If you've got some money to pay in there, pay it in. Yeah. All right. So not financial advice, like I say, but that's the way I sort of do things, and enjoy. And good luck.